Good afternoon. It is Thursday, April 9th, and I promised you earlier this week that we'd put together another video, and really what today's about is kind of answering some of the big questions and concerns that everyone's having around their portfolios, and is it going to be okay? How long is it going to take to recover? Different things like that. And so I put together a presentation to share with you that will hopefully help you understand a little bit more about the strategies that we use and the reason we feel like they are prudent strategies over time, but also some of the realities of what we've experienced here the last few weeks with the coronavirus and the major market downturns. So we've got a lot to cover today, and I'm looking forward to it. And I really think that you should get a lot out of this. I think it'll help you understand things a little better. But as always, as you come up with questions, don't hesitate to reach out. That's what we're here for. Brent and I are both available to talk with you about any questions you have around your specific circumstances. Because remember, what we're talking about today is general in nature. And so it's not specific to any investor. It's not specific to an exact portfolio. It's general. So take that with a grain of salt so you understand the idea is to cover concepts, not to give you the exact advice for your own situation. You always want to talk with the right professional when it comes to that. So what we're going to do, we're going to go over to the presentation, and some of these slides, hopefully you'll be able to see everything, but if you have any trouble, we can get these to you if you request it, to get the actual specific slides for you to review on your own. But today we're just calling this Surviving the Coronavirus, which a lot of people are trying to do as they're staying at home and doing the right things with the social distancing. So let's take some time to dig into some of the things that we've been hearing and some of the questions that people have. So we've got a lot of clients that we've talked with, and there's a lot of the same types of feelings and questions. People are unsure about, are they doing the right thing? Is their plan going to still work? Many people are really scared, honestly, about seeing the decreases in values in their investments and how that's going to affect them long term. People wonder if this is different this time. We hear that each time there's a market downturn, but the truth is every time is different, right? We have different circumstances, different things we have to deal with. So that's something we've heard. Am I going to live long enough to recover? That's something people wonder about. Is this going to take years to recover, or months, or what do you think? And would it be better just to go to cash right now, right? A lot of people wonder, hey, why don't we just get on the sidelines for a bit, wait it out a little bit, see if as things settle down, we can look at getting back in and investing. So I want to talk about each of these things and kind of go through some things today to help address those questions and concerns. Okay, so we're going to break this in. By the way, I put this slide out there because I think it's really apropos today. I'm going to blow it up a little bit so you could see it. But here's the thing. The average person's really not equipped very well for investing. If you think about our primary emotions, our two of our primary emotions are fear and greed. And so that doesn't necessarily go hand in hand with money. So I like this little graphic because some of the things it says, like the market tanked and I should have seen it coming. How many people have thought that before? Or you've got friends or maybe yourself says, I've got a proven system for picking winning managers and investments. And so it always works. Or my research confirms this is a great stock to own. But some of the negative things, like it was a bad idea, but I don't want to sell at a loss, or I wasn't wrong about the stock, just unlucky. So we tend to justify investment decisions over time. And so our goal is to help people try to eliminate as much of this as possible and have a really good plan that makes it so you don't have to worry about timing, you don't have to worry about picking the right stock, things of that nature to have success. So I thought that was a good thing to share today. Okay, so let's get into the four big areas we're going to cover today. First of all, let's look a little bit at market history, see if we can kind of tell how the markets have done over time. Let's look at the reactions the markets had to bad events like this. So what has happened after bad events? Let's look at how about sitting out for a bit, which we talked about. And then lastly, should I even worry? So is this something that really isn't even worth my time to worry about? So let's look at each of those things individually. The first thing we're going to look at is market history. So when you get into market history, One of the things that I think most people have seen is over time, markets tend to do very well. This is a chart going back all the way to 1926 through 2019. And one of the things I do want to point out, and I know this may be a little bit small and not everybody can see it exactly, but up in the top right, it shows that small stocks have actually had the highest long-term return by quite a bit, meaning a dollar would have grown to about $25,617. Large stocks about $9,200. But as you can see, markets have done pretty darn well over time. Sorry about that. Had a little glitch, but we'll bring it back up here. Here's the other thing that I think is interesting for people to see. This shows you what's called the intra-year gains and declines. Most people, we live in a now moment. So if the market goes down 30%, we think, hey, the market's down 30%. We don't really live in annual return climates per se. What this chart shows you is it shows you each year. So the red bar going down shows how much the market went down in a given year. The black line on top shows how much it went up in a given year, the highest point it was during the year. And the blue bar is where it ended up. So one of the things we know is the majority of years, 3 out of 4 years, the markets are up, right? But what we don't always pay attention to is how much they go down and up throughout the year. So I put a line at the minus 10% to kind of show you how many years the market's actually down more than 10%. And you can see it's quite a few. Most, in fact, are down more than 10% at some point during the year. And many times the market's up higher throughout the year than what it ends up. So there's a lot of volatility within the year that you just always have to be aware of. Okay, let's talk about reactions to bad events in the market. So the first thing I want to pull up here is the markets respond to crisis. So what this looks at is just, and a lot of the things we're going to show you today is based on a balanced investor because that's how most people invest. So a lot of this represents 60% stocks, 40% bonds, and a globally diversified portfolio. So what it shows is after different market events, what were the returns after 1 year, 3 years, and 5 years. So the 1 year is the first kind of blue bar. The 3 year is the mustard colored or yellow bar. And the 5 years is the green bar. And what I want you to really pay attention to is that after all kinds of different crises, like the stock market crash, savings and loan crisis, Asian contagion, Russian crisis, .com crash, terrorist attacks, the great financial crisis of 2008, and U.S. debt downgrade in 11, every single time you see what happens for the disciplined long-term investor. They get pretty darn good returns if they stay disciplined. If they try to time it and get out when it's down, oftentimes that's not the case. The next thing I want to look at is markets, how they've rewarded discipline. So this chart actually shows over time from 1970 through 2019, a dollar grew to $69. But look at all those things that happened along the way. Just recently, Brexit, U.S. home prices hitting bottom, the fiscal cliff we dealt with, the Eurozone debt crisis, the S&P 500 down, 46% in 2008 into 2009, Hurricane Katrina, 9/11 attacks. There's been all kinds of things. And they all affect markets in short periods of time. But as you can see, over time, the markets always grow if you stay the course. And that's a really important concept to understand. So how about if we just sit out for a bit? A lot of people call and ask, I think maybe I just want to sit out for a little bit. Is that a good idea, bad idea? Let's take a look. So one of the problems with sitting out is that when you look at these things, you quickly realize that, hey, there's not very many days that actually drive market returns. So if you look at from 1990 to 2019, the market actually returned just about 10% annualized compound return. But if you just missed one day, the best day, it drops to 9.5, 9.5. If you miss 5 of the best days, it drops by almost 1.5% per year. You miss 15 down to 6.5, 25 down to 4.99, and you see where this is going. So the point of this is when you start looking through is that market it always feels right, but market timing in general usually doesn't work out very well. I've seen another study where it shows you if you go out after a down day and you stay out a week, a month, a year, pretty much every single time you would have been better off just staying in as opposed to staying out the week, the month, or the year. And so staying disciplined is really important because there are not that many days that actually drive the market return. So you got to make sure you're in the market when those occur. People think, well, if I miss the bad days, then it won't, that this would change. Well, there is some truth to that, but when you start getting into that game, it's very difficult because if you pull out of the market, you have to know when to get back in. So you actually have to make two decisions correctly in order to get a better return than if you would have just stayed put. So a really important concept. This is kind of an interesting chart, and I put this in just to kind of show you that the majority of days in the market are really, they go between negative 2% and plus 2% return, right, in the market. So, but the one thing I brought this up is you see the red is almost as big as the blue. So even though markets generally grow over time, if you look at returns on a daily basis, it's really volatile, meaning that there's almost as many negative days as there are positive days. So when we sit there and watch the returns today, it can drive you crazy, right? Because so many times you're going to see down days as much as you're going to see up days, and everybody, we get scared when the market goes down. We almost sometimes get a little scared when it goes up because we don't understand what's happening. And so this is not a great exercise to sit and watch it every day. That's why I put that in there for you to review. Here's another reason, I put this in. This is the S&P 500 this year on a daily return basis. Look at all the volatility, the ups and downs. So this is another reason it's very difficult to try to time things. You can see almost every time there was a major downturn, then there was a really quick uptick. And so if you start trying to get cute with it, you can really get into trouble. You look at from around March 22nd through yesterday, there was a pretty significant increase from, almost half the loss was recovered during that period of time. And when you start trying to time that and get in and out and sit on the sidelines, you take a really big risk of missing those quick returns. So remember, markets always price in what's happening or most likely happening in the future, the most likely thing. It doesn't mean that they know the future, obviously. So the reason it went down so quickly is because there were so many unknowns of how bad was it going to be, and how many people were going to die and how much or how long our economy would be shut down. Was as answers start to come clear, or they start to get some clarity, markets tend to stabilize. So it's just an important thing to see. So let's close this out with, should I even worry? So does it make any sense at all even to worry about this stuff? Or should I just shut my eyes, just keep living and try to put it out as much as I can? Well, let's take a look. What I want to start out with is a kind of a reflection of 2000 through 2019, 20-year period, right? So when you look at this, and the reason I want to bring this up is it kind of shows the reason that the globally diversified portfolio generally is going to be your best friend through these ups and down markets. I don't think anyone would argue that 2000 through 2019 was smooth sailing. We had a lot of stuff, including the Great Recession through that period of time. But what it shows you through this slide here is, so the 2000 through 2009, the U.S. stock market, if you can see that first column, was negative 0.95 per year. The S&P 500 actually lost money through that decade. In 10-year period, it made no money, right? But if you look at some of the other parts of the market in a diversified portfolio, like value stocks made about 4% per year, small stocks about almost 8% per year, international value stocks about 7, international small cap 13, and emerging markets almost 11. So there were some actually pretty good returns to be had through that period if you were diversified. Now, if you fast forward to the next 10 years, 2010 through 2019, now all of a sudden the S&P 500 was the winner. So the U.S. stock market actually did better than everything else. The U.S. large growth stocks specifically. They beat the large value stocks by a little bit. They beat the small stocks in the U.S. And the international stocks were not quite as good that 10 years. Although they were positive. You see 5.5, 7.4, and 4.6. So all positive returns. And then, so let's look at it for the whole 20 years. So if we were a disciplined, diversified, globally diversified investor through that period, the S&P ended up at about 6% per year for that 20 years. The large U.S. value stocks about 8, small U.S. stocks about 10, international large value about 6.3, international small around 10, in the emerging markets around 7. So they were all pretty good returns through a lot of bad stuff that happened. But you can see how important diversification is, because if we would have just been in the S&P 500, which a lot of people watch every day and track their investments against, we would have actually had the worst return of any of the different asset classes through that period, even though the last 10 years it was the strongest. So, that diversification helps even out some of those ups and downs of a particular part of the market. So now, and this is just, I wanted to show you this pretty quickly. So what this shows is just the developed markets around the world. And everybody has home bias. They think where they live is better, which is normal. But if you look at, and I know these numbers are a bit small, but I just want you to understand, this is going through all the developed markets like Australia, Austria, Belgium, Canada, etc. Well, the box number, if you see the little colored box, that's the country that had the highest return for a given year. So this shows from 2000 through 2019 which country each year had the best return of all of them. So you could see the U.S., believe it or not, only 1 year, 2014, we had the highest return. Finland actually had 3 different years where they were the highest, but overall it's pretty random and pretty spread out. So the point of that is there is not one country that's necessarily better and always the best investment. And the same thing applies really on the internet or the emerging markets. So just same general concept. So emerging markets are just countries that are not considered developed yet. Brazil, Chile, China, Colombia, Czech Republic. So more emerging countries, but same concept. There really isn't a consistent winner there. They're random, and that's really important to understand. So let's just look at closing this out. Let's look at each 10-year period if we would have just followed our plan of maintaining that balanced, globally diversified portfolio. So balanced generally means about 60% is in stock, 40% are in bonds, in cash, and things like that. So in the 70s, you could see in this chart, the globally diversified balanced portfolio, that dollar grew pretty consistently up to about $3.50. And so that's almost over tripling your money in that 10-year period. The S&P 500 didn't fare as well. It was about $1.77. That's that yellow line. In 1-month Treasury bills actually beat the S&P 500 that 10 years. Ended up about $1.84 for each dollar invested. So the next 10 years, what happened? Well, the globally balanced diversified portfolio, the dollar, great decade of the 80s, money grew extremely well. The dollar grew to $7.32. The S&P 500 grew to $5, and T-bills grew to $2.34. So again, had some ups and downs through there, but basically our money did extremely well through that period of time. In the 90s, we had, it looks like somehow I missed the 90s. So this is 2000 through 2009. What it shows you is, in this case, we just kind of talked about that, the globally diversified balanced portfolio. The dollar grew to about $2, and the S&P actually shrunk to 91 cents, with the Treasury bills growing to $1.31. So in that case, if you weren't diversified, just in U.S. large stocks, you had a pretty tough 10-year period there. And then 2010, we actually didn't have the chart through 2019 yet. 2019 was a good year, so it would be even better than what you're seeing here. But through those 9 years, the S&P actually was a winner. That 9 years grew to $2.71, and then a little higher now. Then ended up through to 19, and then the balance strategy still grew to $2.23. So if you keep in mind, you're doubling your money through those 10-year periods. So in essence, that's around 7% average if you double your money. So those are all really good. And if you look at the long term all the way back to 1970, you could see a dollar actually grew to $422 through 2018, which is kind of crazy. Just in the S&P 500 only, it grew to about $116. So really good results for the long-term disciplined investor, even through a lot of ups and downs that we all experience. So let's kind of summarize what we're talking about. Number one, short-term fluctuations are going to exist in the market. It's normal. It never feels normal. It's always kind of tough to deal with, but it is normal. Building a balanced global portfolio is a prudent way to invest. There's never a best way to invest. I tell people that all the time because no one knows the future. But generally speaking, if you have a globally diversified portfolio with different parts of the market involved, with some good high quality fixed income, you're in a pretty good position to do well through multiple different types of markets. And that's really what we're trying to do, especially as we're coming into retirement and in retirement. Disciplined investors realize good long-term results. You could see that for the people that really stay with it. Things work themselves out. They get better. Companies innovate. New companies come up. Some companies go out of business. But over time, overall, the markets adjust very nicely through all different conditions. Really a key point, investing within the scope of a comprehensive plan is paramount. Brent and I talk all the time with investors is if you have a comprehensive plan and your investments fit into that plan, it makes a huge difference because then you can measure your probability of success. You can really stay on top of it if you're doing the right things to have long-term success. And so if you're trying to invest outside of a comprehensive plan, you probably are going to be wondering all the time, am I doing the right thing? Am I not doing the right thing? So talk with us if you're not sure about that. And finally, this too shall pass. You know, we've been through lots of things in our country and in our world. And we have lots of really brilliant people out there that are going to come up with great solutions, vaccines, treatments for the coronavirus. We'll be better for all this. We'll be able to better handle these things as they come up. And so I think that's really important to understand that, you know, even though it's really hard as we deal with this, everybody's got cabin fever, everybody wants things to get back to normal, get back to work if you're at home. It will happen. I mean, it'll eventually happen, and I don't have a crystal ball. I don't know when, but markets will recover, things will get better, and hopefully we'll be right back to good times in the near future for everyone. So in closing, I hope everybody's staying healthy out there, practicing your social distancing. We all need to do that to put ourselves in the best position to get through this as soon as possible. And thoughts and prayers out for anybody that is dealing with some health issues through this. You know, we're here for anything that you need with questions or just want to talk about some things. So this is Dan Reese and signing off, and wish you guys the best. Thank you.